You're listening to Earnings Unscripted, where we unpack what really happened in today's earnings so you don't have to read the footnotes. I'm Susie, and today we are looking at American Airlines Q4 2025. It is Tuesday, January 27th, and honestly, if you're stuck in an airport listening to this right now, I am so sorry.
Yeah, if you are stuck in an airport, at least you're helping their load factor for Q1.
That's cold, Miro, even for you. But before we get into the misery and the money, just a quick reminder that everything we say here is just our personal opinion, definitely not financial advice. Please do your own homework. Okay, so American Airlines, they posted their results today, and on paper, it looks like a comeback. Record fourth quarter revenue, back to profitability, but the stock... The stock chart looks like a ski slope today. What is going on?
It's the classic sell the news event with a weather delay. Look, the headline numbers were actually good. Revenue came in at $14 billion flat. That's a record for a fourth quarter, up about 2.5%, and they swung to a profit. GAAP net income was $99 million, or 15 cents a share. Compare that to the $114 million they lost last quarter. That's a solid turnaround.
Right, and 15 cents a share is, well, it's positive. That's better than the red ink we're used to seeing lately. So if they printed a record top line and actual profit, why did the market throw a tantrum?
Because the market doesn't care about December. It cares about January. So the stock was rallying all quarter, up something like 36% since October. It even spiked this morning before the call, hit $15.24 a share. Then the execs started talking about the weather and whoop, boom, dropped 7% intraday, closed near the lows.
Ouch. So it's Winter Storm Fern. I saw the alert, 9,000 cancellations. That sounds catastrophic.
It is. They called it the largest weather-related operational disruption in Americans' history. So, sure, Q4 was nice. They even ate a $325 million hit from the government shutdown and still made money. That's impressive. But then they said, by the way, Q1 is going to be a loss because we're currently frozen solid.
Yeah. It's like they finally cleaned up the house just in time for a tree to fall on the roof. So the guidance for right now for the quarter we are in is a loss.
Yep. Adjusted loss per share of 10 to 50 cents for Q1. Basically, the storm is costing them up to $200 million in revenue right off the top. So traders looked at the nice Q4 print, saw the guidance for a Q1 loss, and decided to take their 30% gains off the table.
It really shows how fragile the airlines are, doesn't it? You can have premium revenue surging, which we should talk about because that was a bright spot, but Mother Nature she doesn't care.
She is an uncooperative stakeholder, yes. But you're right about the premium side. That was the engine here. Even with the shutdown and the costs, they squeezed out an operating margin of 3.2%. That's triple what they did in Q3.
Triple the margin. Okay, so the business is working when the planes are actually flying.
When they fly, yes. But there's a tension here, Susie. They're celebrating record revenue, but cash flow is, well, let's just say the bank account isn't growing as fast as the press release implies.
Oh, I feel a Miro reality check coming on.
Always. But yeah, the gap between accounting profit and money in the bank is where the interesting stuff is hiding this quarter.
All right, then. Let's get into the details.
So here is the thing that keeps nagging at me. American is on this incredibly aggressive debt diet. They reduced total debt by $2.1 billion this year. They're basically sprinting to get their total debt under $35 billion, and they now say they'll hit that target in 2026, a full year ahead of schedule.
Which sounds fantastic, right? I mean, in this interest rate environment, paying off the credit card early is usually the smart move.
Usually, but you have to ask how they are paying for it. Because if you look at the cash flow statement, for the full year of 2025, their free cash flow was negative $83 million.
Wait, hold on. If they didn't generate any free cash. Actually, they burned cash. How did they pay off $2 billion in debt?
Exactly. So they drained the savings account. Their total liquidity dropped from $10.3 billion down to $9.2 billion. So roughly $1 billion of safety net just vanished to service the balance sheet goals.
Which feels risky? Like, they're paying the mortgage by selling the furniture?
Not the furniture, maybe just the spare car. But yes, it's a trade-off. They're betting that the operation is stable enough now that they don't need that extra $1 billion in liquidity. They'd rather lower the interest payments. It's confident, I'll give them that, especially when you have winter storms wiping out profits in Q1.
Right. It assumes smooth sailing, and the airline industry is famous for anything but smooth sailing. So where is this confidence coming from? Is it just that people are flying more?
Actually, no. And this is the second really interesting thing in the data. People are flying less, but paying more.
Walk me through that.
So look at the load factor, basically how full the planes are. It dropped significantly. In Q3, it was 86%. In Q4, it fell to 82.7%. That's a lot of empty middle seats. Normally, that would kill your margins.
Because you're flying the same heavy metal tube, but with fewer tickets sold.
Right. But then look at the yield. The revenue per mile per passenger, it shot up. It went from about 18.7 cents in Q3 to over 20.5 cents in Q4.
Whistle, that is a massive jump.
It is. And it tells us they are fundamentally changing the strategy. They aren't trying to fill the bus anymore. They are optimizing for the front of the plane. The CFO explicitly said premium unit revenue outpaced the main cabin by 7 percentage points.
So basically, they're deciding it's better to fly a slightly emptier plane if the people on board are buying the flagship seats and the flexible corporate fares. It's the the gentrification of the fuselage.
I was going to call it yield management, but sure, gentrification works. But it creates a weird dynamic. Because while revenue is up, their costs are creeping up too. CASM-X, their cost per seat mile, went up to 14.5 cents.
Because serving champagne costs more than tossing a bag of pretzels?
Partly, but also when you fly fewer people, your cost per passenger naturally rises. You lose some economy of scale. So they are trapped in this high-stakes game now. They need those high yields to cover the rising costs. If a recession hits and corporate travelers switch back to Zoom, they don't have the volume cushion they used to have.
That's the scary part. You can't exactly discount a lie-flat seat to $90 to fill it up last minute without ruining the brand.
Precisely. It makes the revenue quality better, but the business model more rigid. And frankly, with them putting all their chips on this premium strategy while draining their liquidity to pay debt, it leaves very little room for error.
It's like walking a tightrope, but they decided to toss the safety net to make the walk look cooler.
You have a way with metaphors today, but yes. And don't forget the distraction of the DFW hub rebanking. They are completely overhauling the schedule at their most profitable hub to this 13-bank structure to improve reliability.
Which sounds like open-heart surgery while running a marathon.
It kind of is. If they pull it off, efficiency goes up. If they mess it up, well, DFW is the heart of the network.
So we have a company that's shrinking its cash pile, betting on expensive seats, and rewiring its biggest hub. That is a lot of moving parts for a management team that's currently battling ice storms.
It is. So, yeah, let's step back for a second and think about what all this means for where they actually are heading in 2026.
Yeah, because the guidance was interesting. So where does this leave them heading into next quarter?
Well, honestly, it leaves them in a bit of a trust us zone. Because look at the gap in the guidance. They are telling us Q1 is a write-off, a loss of up to 50 cents a share because of the storm.
Right. Jam tomorrow, but ice today.
Exactly.
But then they turn around and say, don't worry, for the full year 2026, we're going to make roughly $2 a share and generate over $2 billion in free cash flow.
Whoa, that is a steep climb. So they have to dig themselves out of this Q1 hole and then sprint for the next 9 months just to hit those numbers?
Yes, they are projecting a massive ramp up. And remember, they're banking on that premium revenue holding up and Latin America, which they admitted is still under pressure, stabilizing. It feels like a hockey stick year. If the economy softens or another storm hits, that $2 billion in free cash flow starts looking imaginary.
It does make me wonder about the credit card piece, though. They shifted everything exclusively to Citi in Q4. Is that the ace in the hole?
It's the stabilizer for sure. Card spend was up 8%. Advantage enrollments up 7%. The loyalty program is practically a separate, profitable bank inside the airline. That is the one engine that doesn't care about the weather.
So, big picture, it feels like American is trying to graduate. They're moving away from being a commodity bus service to being a premium travel brand. And they're paying down the credit card to prove they're being responsible adults.
They are trying, but operations keep pulling them back to reality. The strategy is sound, premium yields, lower debt, but execution is messy. Until they can get through a quarter without a special item or a meltdown, the market is going to keep that valuation on a short leash.
Fair enough. They're building a better airline, but they're still flying through turbulence. Okay, I think that's the signal to land this plane before we run out of metaphors.
Please, before you start quoting pilot announcements.
I was thinking about it. Okay, that's a wrap on American Airlines for Q4. Thanks for hanging out with us while we nerded out on the numbers.
Always a pleasure. Fly safe out there.
You too. And before we cut the feed, a quick note on what you've just heard. Earnings Unscripted is an experiment by a small team of enthusiastic humans exploring the frontier of AI and how it can be used to enrich us. This episode was created entirely by a team of AI agents, from the research analyst and script writer to us, your hosts, and a fact-checking QA specialist. It's a project to see if we can deliver high-quality, up-to-date information in a way that would hardly be possible otherwise.
If you have questions or comments, we would actually love to hear them. Reach out at earningsunscripted@datamadness.ca or follow the project on X.
See you after the next call.